There is a dollar sitting in your wallet right now. You think you own it. You think it's yours, a fixed, finite thing. You spend it, it's gone. Someone else has it. Simple. Except that's not how money works. Not even close. That same dollar, the one you just handed to a cashier, will be spent again, and then again, and again after that, before it finally disappears into the fog of the financial system. That single dollar will have purchased maybe 5, 10, or even 20 times its own face value in goods and services. How? Why? And more importantly, what happens when that chain breaks? That's what this is about. Let's go back to 1933. The United States is in the middle of the Great Depression. Banks are closing. People are pulling their money out of accounts and stuffing it into mattresses. Unemployment is above 20%, and economists are watching something terrifying happen in slow motion. The money isn't disappearing. There's still the same number of dollars in existence, but somehow the economy is collapsing anyway. What they were witnessing, and what took years to fully understand, was the death of a mechanism so fundamental to modern finance that most people never even learn it exists. It's called the velocity of money, and once you understand it, you will never look at a dollar the same way again. Here's the setup. Imagine a small town, one street, 10 businesses, $100 in total circulation. You have that $100. You go to the bakery and spend it on bread. Now the baker has $100. She goes next door to the butcher and buys meat. The butcher has the $100. He pays his landlord. The landlord pays a handyman. The handyman buys coffee. The coffee shop owner pays an employee, and so on. By the time that original $100 makes one full loop through town, it has generated hundreds of dollars worth of economic activity. The same bill, the same ink, the same piece of paper. Now imagine someone gets scared and takes that $100 and locks it in a safe. Every single transaction in that chain stops. The baker can't buy meat. The butcher can't pay rent. The handyman doesn't get called. The coffee goes unsold. An entire ecosystem of economic activity, built on $100 moving, freezes because the money stopped moving. That is the velocity of money, not how much money exists, how fast it changes hands. And this is where it gets interesting. Economists actually measure this. The velocity of money has a formula. You take the total value of all economic transactions in a country, divide it by the total money supply, and you get a number, a multiplier. In the United States in the late 1990s, that number was above 2. Every dollar in existence was generating roughly $2 of GDP. Today, it's sitting around 1.1, sometimes lower. That means for every dollar in the system, it's generating barely more than $1 of real economic activity. Think about what that means. Over the past 2 decades, the Federal Reserve has created trillions of new dollars. The money supply has exploded, but GDP hasn't kept pace. Not because the money isn't there, because the money isn't moving. We built a bigger river, but the current slowed down. Now here's the part where the banking system enters the picture and where things get genuinely strange. You deposit $1,000 into your bank account. You can see it right there on your phone. $1,000. Available balance. Here's what you don't see. Your bank takes most of that deposit and lends it to someone else. Under the old reserve requirement rules in the United States, banks were required to keep about 10% on hand, $100, and could lend out the remaining $900. That $900 gets deposited into another bank. That bank keeps $90 and lends out $810. That gets deposited somewhere else, which gets lent out again. Your original $1,000 has now become, through this chain of lending and depositing, roughly $10,000 in the broader economy. This is called the money multiplier effect, and it's been a feature of banking since the 1600s. Your $1,000 didn't clone itself, but it behaved as if it did. You still think you have $1,000. 9 other people also think they have money that traces back to that same deposit. In a functioning system, one where not everyone tries to withdraw at once, this works fine. You already know what happens when it doesn't work fine. It was called 2008. But wait, there's a twist that almost nobody talks about. In March 2020, the Federal Reserve quietly eliminated reserve requirements entirely. Banks in the United States are no longer legally required to keep any percentage of deposits on hand. Zero. The reserve requirement is zero. The official reasoning was that other regulatory tools had made the old reserve ratio obsolete. And that's partially true. There are now other capital buffers and liquidity requirements in place. But the symbolic weight of that decision is hard to overstate. The last visible guardrail, the one most people imagined was sitting between deposits and speculation, was removed, not during a crisis, not as emergency policy, just quietly as a regulatory update during a pandemic while everyone was looking elsewhere. The money multiplier effect is now, in theory, uncapped. Here's where the uncomfortable math lives. Every dollar in the system carries with it an implicit assumption that it won't all be demanded at once. The entire architecture of modern banking is a bet on human behavior being predictable and staggered. Some people spend today, others save. Some borrow, others repay. The flows offset each other and the system stays liquid. But velocity and multiplier effects are two sides of the same coin. When money moves fast and multiplies freely, economies grow. Jobs appear. Businesses expand. Asset prices rise. Everything feels fine. When velocity drops and confidence falters, the multiplication runs in reverse. Loans get called. Deposits get withdrawn. Banks stop lending. Businesses contract. That $10,000 born from your original $1,000, it can collapse back toward $1,000 almost overnight. Not because anyone stole anything. Not because there was fraud, just because the chain of trust that made the multiplication possible snapped at one link. This is called a credit contraction, and historically it's one of the most destructive forces in all of economics. Not because money disappears, because it stops moving. Let's zoom out. Right now, as you're watching this, there are roughly $21 trillion in the broad U.S. money supply. The GDP of the United States is around $28 trillion. That velocity ratio, just over 1, tells you that money is barely turning over. Compare that to a healthy pre-financial crisis economy where velocity ran closer to 2. That same $21 trillion would be generating $42 trillion in economic activity. Instead, a significant chunk of newly created money is sitting in reserve accounts, in corporate cash piles, in investment vehicles that don't touch the real economy. The Fed created money, the money didn't move. And here's the quiet irony in all of this. The very policies designed to stimulate spending, near zero interest rates, quantitative easing, emergency liquidity programs, may have contributed to slowing the velocity of money. When money is free and credit is cheap, the incentive to deploy capital urgently disappears. You don't rush to spend or lend when you can borrow more tomorrow for nothing. Cheap money, paradoxically, can make money lazier. So where does that leave us? The dollar in your wallet is not a static object. It's a node in a network. Every time it moves, it activates a chain. Every time it stops, it breaks one. The scale of modern financial systems means that this chain now runs through derivatives, shadow banking, money market funds, repo markets, and instruments that didn't exist 30 years ago. The multiplier effect doesn't just operate through bank deposits anymore. It operates through layers of financial abstraction that most regulators only partially understand. That's not speculation. The Bank for International Settlements, essentially the central bank for central banks, has published research suggesting that the global financial system now operates with leverage and interconnection that makes pre-2008 risk models look naive. The dollar you spend at the coffee shop enters a system that, several steps removed, is linked to sovereign debt markets in countries you've never visited, collateralized by assets that haven't been stress-tested, moving at speeds no human can monitor in real time. And here is where the story lands. We built a financial system that runs on velocity and trust. Those two things are invisible. They don't appear on any balance sheet. They can't be printed by a central bank. They can't be legislated into existence. Every model, every policy, every regulation assumes that money will keep moving, that people will keep trusting the chain. History says that assumption holds, until suddenly it doesn't. The Great Depression wasn't caused by a shortage of dollars. It was caused by a shortage of movement. 2008 wasn't caused by a shortage of assets. It was caused by a collapse in the trust that made those assets worth something. The velocity of money is, in the end, a measure of collective belief. When people believe the system works, they participate, and the dollar keeps multiplying. When they stop believing, even briefly, even partially, the math runs backward. Your dollar will be spent multiple times before it disappears. That's not a glitch. That's the entire design. The question nobody can answer with certainty is this: how many times can it multiply before the chain requires more trust than the system has left to give?